Hello and welcome to Options Guide TV. My name is Brian Overby, the author of the Options Playbook, and I'm going to be your host here for about the next 25 minutes on Options Guide TV. Let's lean into the bearishness today in the market. It's not very bearish, but the market is down right now around $5 or so. It's if there's any ruthers, I'd rather think the market's going to lean to the downside than to the upside. Some of the mega cap tech stocks are having some issues, and that's kind of drawn down the market a little bit. Nothing really too big to report. The sky's not falling, but I want to do a zero DTE butterfly today, mainly because next week we're going to have a plethora of earnings that we're going to look at. So we did look at the Goldman Sachs trade, and that looks really interesting today. So we will see where we land at on that trade. I was really happy that Goldman came back. I do think that everything that has happened in the financial space has to do with news out of Washington more so than the actual reports of earnings from the companies that were reporting earnings this week. We'll talk a little bit more about that because we got to get this trade off. 11:05 Eastern time, as I've always said, when I do zero DTE trades, like to get them done before 10:30 if possible on a just standard day. But right now we're going to lean bearish. We got the market at, according to the derived value, we're at 69.40, and we're going to sell that 69.40 contract. Let's see right now, 69.42, 69.40. Yeah, I don't mind that at all. So we're a little bit out of the money on the 69.40. We're at 345. I like that. Okay, here we go. Here's the call. Here's the trade. We're looking to use the zero DT, the January 16th expiration, which is this Friday. We are going to buy one of the 69.50 strike put options. We're going to sell two of the 69.40s, buy one of the 69.35s. Midpoint is $3.45, and that's where I want to trade that. $345 per 1x2x1 open wing butterfly that is in the account. I'm going to send that to the what if calculator. We'll talk a little bit about it. So I would be trying to execute this sooner than later, a little bit late as always, since we kick off the show at 11 o'clock. Put the trade on, realize that 340 is your max, $345 is your max risk per butterfly that is executed. If the market goes down, we're going to be fine. If it goes below your lowest strike, the 69.50 strike call option, if it goes below that, we're going to be, this thing has to trade for $5. All right. So the difference between the higher strikes, the long put spread is 10 points, 69.50 to 69.40. That's 10 points. That is your winner. That is the one that is doing the lion's share of the work for you. The offset is the short put spread, 69.40 to 69.35. That's 5 points. That means that if the market goes below the lowest strike, it has to trade for $5. We put this thing on for $3.45. Then you have $1.55 that you can make if the market finishes below the 69.35 level, and that would be down in this range. Okay, it's saying 190 here. That would imply that we got it off for 310. Yeah, 5 points. 310 would have been a great fill, but that's what it grabbed when it came into the calculator. 345 was a good fill at this point in time because it's already creeping back up. It's at 385 right here. What has happened with the actual SPX right now? It is 69.44 at this point in time. 69.42 and a half. So it's moving. I want to lean into the bearishness a little bit. If anything, I think we're neutral to bearish on the market today. The Mag 7 is going to start announcing earnings soon next week on Tuesday. So we'll have a Monday show. We got US Bank Corp. We got Netflix Tuesday after the close. So that's usually the first in the Mag 7 group. And Netflix has had a tough time. They're in that battle over Paramount. And the stock has I guess the stock just after having being a darling of the marketplace has recently struggled. So the earnings report, I think, will be an opportunity for them to get back on track. When a good stock's been beaten up like that, usually earnings can spark something, and we'll probably lean to the upside on Netflix. Valuation has been a problem ever since the company went public. They've always traded at higher valuations than people think they should, but they always seem to continue to go higher. Then we have Johnson and Johnson on Wednesday. We have Capital One that's going to be announcing at the end of the week, which would just be interesting with the insurance and credit card thing, and maybe comments around that. But yeah, we'll definitely look at something on Monday for Netflix on Tuesday. Let's see. Market's just kind of hanging right where it's at. All right, so let's look at the Goldman Sachs trade. So on Goldman Sachs, we did a skip strike butterfly, and the market ran up and hit the short strike after the earnings announcement. So right now, and actually this is probably fairly accurate, it's actually drawing the profit and loss fairly well right here. And this is where we're at, right at the precipice. Now, this green line has to morph the yellow line ultimately. Now, it's saying that the trade, let's send it to the ticket, it's going to be a net debit. Okay, a net debit of 60 cents. That means that if we flip the script, we put this trade on for a 40-cent net credit. And if we sold it, we would be selling it for, well, right now it's a 40-cent net credit. So we would get a total of, excuse me, we'll get a total of 80 cents on the trade. I couldn't even get enough time to hit the mute button. Sorry about that. So a net total of 80 cents on the trade would be our profit. Now, with the market on this side of the Goldman Sachs butterfly, it's a skip strike, and we did a skip strike on purpose to change things up a little bit. First of all, there was a little bit of bearishness, so we weren't quite as bullish when we were looking at the JP Morgan trade. Okay, I got to find my mute button. Sorry about that. And when we were looking, and the JP Morgan trade is probably battled back too. It might actually be profitable at this point in time. But we put this on, market's here. If the market starts going up, we might be able to hit the maximum. So I'm not worried about this trade until we see the market go beyond our short strike on our call option, our 970 strike. So let's go back and look at, let's look at the options grid on Goldman. Uh, 965 short 2 of the 970s, long 1 of the 980s. Net credit right now, it's a debit. It's highlighting that it's a debit of 50 cents. Means if we flip it, if we sold this, and I'll do it to show you how we close it. You sell, you buy, and you sell. And now it's showing a net credit of 58 cents. So the fact that it's a $966 stock, this premium, which is what we need to go away, this 970 strike is sticky. It's taken a little bit for this time decay to happen. Because of this, once again, almost like our 0 DTE SPX trade, we need at every half hour that goes by, if the market stays where it's at, this net credit is going to start creeping up. And it's all because you have to buy two of these back. These are hurting you, right? You have to close them. This is where your risk is on these short option contracts. They're helping right now, but they're a risk to you if the market goes up above 970 in this instance. So we could take it right now. We put it on. We're trying to get a net credit of 40 cents. Remember, we build this as an alternative to doing the short call spread. The short call spread was about 80 cents. We did the skip strike butterfly for a net credit of 40 cents, hoping to make that 40 cents, knowing that we had a hedge on. So now, if we had just the short spread on, we'd be nervous right now. We wouldn't be happy about this trade at all. But because we did the skip strike butterfly, now we're happy because we built the hedge into our short spread. So I always like to think of skip strike butterflies as an alternative to a short call spread as opposed to an alternative to a butterfly. So it 967.10. Okay. Now it's at a minus 20. If it hits 970, we just want to get out. We don't want this to go against us, and we don't want to mess around, even though I do feel like we should be getting paid more, bluntly. If we hit 96.70 on the what if calculator, let's go here, and we hit this strike, we got a little bit of room for the end of the day. We got another 5 points before our risk kicks in. And then from that point on down, this trade, then that's where our loss could be at. So, yeah, I'd think about closing it. At any point in time, you can close it. Yeah, when we started, it was a net credit of 40 cents. And we need some time to get it happen. In a couple of hours, this, if the stock's right where it's at, it's now a net credit of 41 cents to close. If the stock stays where it's at, this is going to look a lot prettier. The maximum it could trade for is $5, but that would mean that it went out right at expiration, right at the strike. Now, here's what's different about messing around with the Goldman Sachs trade. First of all, you're dealing with a brokerage firm. You have a very expensive underlying stock. You have short call options around it. The entire position is protected, but you don't know what the brokerage firm is looking at as far as the trade is concerned. These are not cash settled, and there is a potential for being assigned, and brokers might screw that up for you. Honestly, that's straightforward. If they decide that they don't like this risk or they don't understand the strategy, they may just close the position out. So as you get closer and closer to the close, you have that risk. And then the other risk in the scenario is that, I mean, that's the ultimate risk is the assignment. And what I was trying to say is on the SPX trade, it settles in cash. So it's not a concern. As long as you are covered by your cash in your account, you can't lose any more than the margin requirement, which means the market would have to, on the zero DTE, we paid a net debit. So that net debit is going to be the maximum risk that we have. If the market goes with you, all that happens is you got cash in your account where cash used to not be. And so it's a different dynamic on a zero DTE basis, but definitely an interesting trade here on Goldman. It's going to be a fun one to watch by the end of the day. And then good news out of Goldman. Once again, the investment banking side of the equation is looking really strong. I think, as I mentioned on Wednesday's show, that I do think that the news coming out of Washington about credit cards getting capped at 10% drove some of the bank stocks down, and I think that was a buying opportunity. On Goldman, market ran up quite a bit after their earnings report, more than the expected move to the upside. And let's see where JP Morgan is at right now, actually, because it has brought with it. JP Morgan is at 311. No, we're still not quite there. We didn't quite make it all the way back on JP Morgan. So here's the downturn. We needed to get back to about right here. And then Citi we had. Let's see where Citi ended up at now. Take a quick peek. And we're froze for a second. But those are the trades that we were looking at. Okay, there's Citigroup. Citigroup made a strong comeback. Yeah, so we wrote it down and kind of came back up. And Citigroup had a really, their investment banking fees were up like 32% year over year in that instance. So not too shabby overall. All right, now where do we got? So we got the Goldman Sachs trade. We got the SPX trade. Let's go back and take a quick peek at the SPX trade inside the what if calculator. See where that market is at. Send that one to ticket. Market's going back up on that. So we're at $3 right now, and we got the SPX trading at $69.49. $3.15 on the trade. All right. Well, any questions on either of these two trades? Next week, we're going to look at Netflix on Monday. We'll look at doing probably a butterfly Netflix. Expensive underlying stock. Don't know why we wouldn't do some type of butterfly with that. They announce on a Tuesday after the close. So we'll probably lean in and be a little bit bullish. And we'll probably end up looking at doing a little bit more out of the money as opposed to the JP Morgan trade that we did. Out of the money, call spread, call open wing butterfly. That's what I'm going to look at doing on Monday morning for the announcement on Tuesday afternoon. That's it for this edition of Option. Well, let me know any questions. Nothing. And good morning, Kurt. Good morning. And that's it for this edition of Options Guide TV. We'll come back on Monday and we'll look at the earnings. And we have, after that, we really start kicking off with the Meg 7 earnings. So with that said, we'll see you Monday morning, 11 a.m. Eastern time on the next edition of Options Guide TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.